Key models and theories which we are going to discuss here. The role of financial intermediaries. We discussed it. We says that financial intermediaries, they work as the agents, the middle parties to connect with the borrowers and lenders. And we'll talk about a little bit of money market instruments. We are not going into great detail in this chapter. So financial intermediaries, a financial intermediary links those with surplus funds, example lenders, to those with fund deficit, example potential borrowers. You see, within any economy, if we speak about like in economics language, we call it a household. You have households and you have businesses. Households means individuals and businesses, of course, means businesses. So some households and some businesses, they have more funds than their needs. They have savings, or maybe their earnings are more, their expenses are less, or for any reason, they have surplus funds. And we call them lenders. These are the households, individuals, or businesses having surplus funds. We call them lenders. They lend money. On the other side, there are some other households and businesses who are short of funds, who need cash, who need funds. We call them borrowers. So you can imagine that within your economy, there are hundreds and thousands of borrowers and hundreds and thousands or millions of lenders. They do not know each other. Maybe even if they know each other, they do not trust each other. There is no mechanism through which the funds will transfer from the lenders to the borrowers. So there should be a mechanism which is controlling or giving a system, giving a channel so that these funds should transfer from the lenders to the borrowers, from the surplus to the shortage. And this is the job which is done by the financial intermediaries. So for example, commercial banks. So a lot of people, they go and they deposit money into their bank accounts, in current accounts, in saving accounts, in time deposits, and so on. So people who are putting money into the bank. On the other hand, there are other people who want to borrow money from the bank. So what bank is doing? Bank is receiving money from one group of people and entities, and they are lending this money to another group or of people, individuals or businesses. So commercial banks is one example of financial intermediary, and they do this job perfectly. Now, why do they do it? How do they do it? Or why borrowers and lenders cannot talk to each other directly? Why do we need financial intermediary to be in between? We are going to discuss it in the next slide. Finance houses are there who provide such type of investments. Mutual societies is another example. Our focus will be on commercial banks, by the way. We are giving these names, finance houses or mutual societies, but we will not be discussing them in detail because the purpose or objective is to discuss how banks will play their role. Institutional investors, example, pension funds and investment funds and so on. Like pension funds are always investors. They have surplus funds. So people, when you work in some organization, a part of your salary goes to your pensions. And so pension funds are always with rich cash and they have surplus funds and they need to invest these funds. So we call them institutional investors. Now, financial functions of intermediaries. So we said this is financial intermediaries, examples. Now, what are their functions? What do they actually do? So number one, they do aggregation. They do aggregation. Aggregation means that small amounts of deposits, small amounts deposited can be aggregated to make large loans. For example, as an individual, you put $1,000 in a bank, your friend puts $2,000 in a bank, another friend puts $5,000 in a bank. So a lot of small individual investors, not investors, lenders are there who are putting their little savings in the banks. Now, in that particular bank, one business or one organization, one company comes in and says, I need $1 million loan. Now, I don't have $1 million to give them. You also do not have $1 million. But what the bank will do, bank will collect 5,000, 3,000, 10,000, 5,000, 3,000 from hundreds of lenders or hundreds of people who are with surplus fund, make it together and give it 1 million to that person, which is called aggregation. So banks, they aggregate the funds. They collect funds, they aggregate it, and then they decide that how should they give these funds, to whom they should give these funds. Economies of scale. Administration of depositing and lending can be made very efficient because you know what? At individual level, let's suppose there are 1,000 people here who are the lenders, and there are 500 people here who are the borrowers. If they have to deal with each other individually, it will become very expensive and very time consuming. Everybody has to talk to everyone. So that makes the job very difficult. So we put the bank in the middle. So everybody putting their money in the bank, and those who need the funds, they come here. So bank comes here. So bank is pooling the money, and it becomes economies of scale because they do it at a large level. So it becomes very cheaper and it becomes very efficient. And then there is a risk pooling function here. There is a risk pooling. Deposits are aggregated and lent out to many institutions. This is less risky for depositor than a one-to-one arrangement. Because you know what? Let's suppose that if you go for a one-to-one arrangement, if A gives funds to B, $10,000, let's suppose, or let's call it $1,000, whatever. And then B, for some reason, B goes bankrupt. If B becomes bankrupt, A will lose all of its money. That's a very risky proposition. But when it is done through a bank, when so many people are putting money here, and the bank has got $100 million, maybe $200 million, maybe $500 million in their funds. Out of $500 million, if there is one borrower, B, who goes bankrupt with a loan of $10,000, it does not make much difference because the bank has spread the risk too much. So the bank still has got $500 million out of 10,000 has gone bankrupt. So they still have too much money to satisfy to meet the obligations of these depositors or lenders. They will return back. Your bank will never tell you that because one of their, if you put money in a bank, imagine a situation in real life. You go to a bank and you put your money, $10,000 in the bank as a deposit. 3 months later, when you go to the bank, do you think or do you expect that the bank will tell you that, Mr. Ali, we gave loan to X company and X company has gone bankrupt and therefore your money is lost? Do you think bank will say to you? No, bank will not say it to you because bank has already done its risk pooling. So if anything goes wrong, the banks are usually able to manage it unless or until there is something which is so huge that the bank itself goes bankrupt. Then that is a different case. Otherwise, it will not happen. And then portfolio effect. Investment funds can invest in a wide range of shares. Portfolio effect means that banks will actually, when they have this $500 million, they will invest this money in different types of instruments, in different types of house financing, car financing, personal loan, credit cards, business loans, short-term loans, and so on and so on. And they will also invest in some money market instruments. So they distribute. Number one, they do it at a very large level. And number two, they do it in different types of businesses. I'll just for the sake of this risk pooling thing, I'll tell you, I use the word spreading the risk. Imagine, you don't go to a bank. You've got $10,000, okay? You got $10,000. If you have $10,000, this is you have one option that you give this $10,000, all of that $10,000 to one person called B. If anything happens to B, your $10,000 will be lost. Another option, which you will not have, but let's suppose that if you could do that, if you have $10,000 and this is you. And if you have by chance an option to give $100 to 1,000 people, okay, you're not giving one person 10,000, you are giving $100 each to 100 people. 100 people. So if any one of them goes bankrupt, how would you feel that? You will not be feel too much damaged because you still have 9,900 coming in. You only lost this one. I mean, in real life, you cannot do this. This is what bank is doing. In real life, you can do only this, which is very risky. And this is the model which the banks will follow. And I just explained to you that imagine that if bank is not there, and if you had an option of, we call it risk pooling. If you had an option that, okay, I'm not giving out 10,000 to one person, I'm going to give $100 to 100 different people. You take 100, you take 100, you take 100, you take 100. And if for some reason one of them goes bankrupt, you still will not be in loss because you are making some earnings from here. So although you have lost your $100, but you have made the interest from these people, and that interest will ultimately still put you in a positive. It still gives you like a profit or in a positive cash flow situation. This is what we call risk pooling. Okay, so you spread the risk. You spread the risk over too many individuals or over too many instruments that it becomes that one individual or one particular company or one particular instrument, it becomes negligible because you have spread it too much. Okay. Then there is another function which they do, we call it maturity transformation. This is also very important. Maturity transformation. How does it work? You know, we discussed that there are individuals who have surplus funds, and there are individuals and companies who are short of funds. So if I have $10,000 and I want to put it in, and I have this money surplus, not for my full life, actually. I've got this money for 6 months. So I have 6 months. For 6 months, I have $10,000 extra with me, because after 6 months, maybe I'm planning to buy something. I will, I want to buy something. So for next 6 months, this money is extra. I don't need it. So if I go to a bank, I can put this money in the bank only for 6 months. If the bank is not there, let's suppose for a moment that the bank is not there. So if I want to give this money to B, B says, I need the cash for 2 years. B need $10,000. B says, Ali, do you have $10,000? I say, yeah, I've got $10,000 and I can give it to you. B says, yeah, I need 10,000, but I need it for 2 years. I say, you know what? I have 10,000, but I can only give you for 6 months, not for 2 years. He said, no, I cannot return back in 6 months because I'm going to invest in some business and I will only be able to give it back to you in 2 years' time. Now we are stuck. So cash is there, money is there, but time period is not matching. So maturity transformation, when a bank will come inside, bank say, okay, I'm in the picture. Bank comes inside, bank takes this money from me for a period of 6 months and give it to him. And when the time comes in after 6 months, when I go to a bank and I say, okay, give me my money, they will not take it back from B. They will actually give it back to me because somebody else has deposited with them. So C came in during this time, C came in and C gave 10,000 to the bank, and the bank will return me back my 10,000, not by taking from B, but from taking from C. So this is maturity transformation. They manage different maturities of this because buyers, lenders and borrowers have different maturity requirements, and banks will manage it. Convenience for investors. Intermediaries offer a wide range of interest rates and terms and types of investments. Different types of investment: 3 months, 6 months, 1 year, 2 year, 3 year, 5 year. Convenience for borrowers. Intermediaries offer a wide range of interest rates. So house loan, car loan, personal loan, credit card loan. So there is a variety in terms of interest rates, in terms of their durations, and so on. So these are the functions of intermediaries which they perform to connect buyers, borrowers and lenders. I always say buyers and sellers, borrowers and lenders, and they solve these problems. Otherwise, these are the problems with borrowers and lenders they cannot solve on their own. Financial markets. So we talked about financial intermediaries.